Just earlier today, Kraft Heinz KHC stock announced that it was splitting into two separate vehicles. You have Global Taste Elevation Company and North American Grocery Companies. Frankly, I can't think of worse names. Not surprising to see Warren Buffett calling out that he's disappointed in the announcement in the Kraft Heinz split. And his disappointment seems well justified, seeing that he's been an investor, helped actually pioneer this deal that merged Kraft and Heinz, and he's lost about 70% of its value in that mega investment over that time period. And you could think of a lot of other companies that might have been perceived as riskier during this time, but there was this perception that, hey, if we follow a playbook like this, and this was a popular 3G touted book. Hey, zero-based budgeting. Let's just cut all costs and we can double our profits. Didn't quite work out as they expected, losing the vast majority of its value. And, he's disappointed not only because of the poor outcome, but he owns nearly 1/3 of the company, 27%. And here it is, management decided to do this without really getting his approval. And first of all, that just strikes me as a terrible idea because he's Warren Buffett. It's Berkshire Hathaway. You don't want him going on CNBC like effectively he did today. He just said to Becky Quick, he didn't actually want to be on the air, saying that he's disappointed. In my opinion, the likelihood that management is still in place in 6 months to a year from now is not really high. So I would be searching job offers if I were in their shoes, just because, or exploring the job market. That said, I can't imagine that there's a lot of demand for failing with some stable brands sort of businesses, saying, hey, congratulations, I ran Kraft Heinz into the ground. That said, Buffett's saying, look, I'm going to do whatever's best for Berkshire. And he's possibly interested in selling his shares. However, he won't sell his shares just as a block. He wants to make sure that, if he's selling his shares, there's a full tender. So either someone says, hey, I want to buy the whole company, or I'm making a tender offer at X price and he gets to share with the minority shareholders. Buffett always thinking about his reputation, always thinking about, am I treating other people equally? Because the truth is he could probably get some sort of premium for his block of stock, but instead he's saying, no, I'm not going to allow that. It's either a tender for the whole company or just someone tenders for shares, and I will get my proportion of that exit if I consider the price, interesting. And so this is, there are several interesting dynamics here because you will likely have Buffett's, not being happy, plus a whole world of investors that go home. This is sold off a lot, and we'll talk about the valuation in just a second. Maybe you start getting some activists involved. And so, and then Warren Buffett says, why wouldn't I work with, someone else that's going to respect me? So looking at it, you do have these two, very cash generative companies, even though I think the commentary about Global Taste Elevation Company, they should just come up with something crazy like Mondelez or something like that for a name. Nevertheless, here it is, $4 billion in Global Taste Elevation in their adjusted EBITDA. That's their core profitability. And North American Grocery around $2 billion. So you're talking about billions of dollars in free cash flow, around $3 billion in free cash flow per year. And the stock now, it continues to sell off in response to Buffett saying he's disappointed, their poor execution. Now it's trading around 10 times or under on a price to free cash flow basis. So that alone is enough to get the deep value investors, the Michael Burrys of the world, to say, maybe this is worth taking a swing. After all, if this is something that Buffett bought it at this price and now you're able to get it 50%, 70% off from his price, maybe there's a bargain here. And I think it is worthwhile to reflect on this chart for a second when you're talking about 10 times free cash flow or under. So just thinking about the pieces, that means if the business is flat and valuation doesn't change, that free cash flow alone, if 100% is returned to you as a shareholder, that means you're getting about a 10% yield. That's generally better than the market does over time. So there is a real chance that value investors get involved in this. Activists get involved in this saying, if the fundamentals can just be flat on a combined basis, then this could be quite interesting because arguably, once again, flat fundamentals, that 10% free cash flow yield plus maybe you are able to get a little bit of growth. Maybe you are able to get a little bit of multiple expansion, because right now, from a free cash flow perspective, you're trading at the lows of where it's trading at COVID. Another reason why Buffett's disappointed is splitting this company up is actually going to result in more management costs, a couple $100 million of effective inefficiencies versus having the sales, admin, general expenses under one company overseeing both. And he would know that you can operate a conglomerate on a decentralized basis. You can have each company operating with their own management, but you don't need to necessarily split it apart. You don't need to have, let's say, two publicly traded tickers. So the whole idea for him to say, oh, we got to split this up to create value. Yeah, he's calling BS, and he's saying it's disappointing. And so the question is, looking at what's going on with Kraft Heinz, 10 times free cash flow, is this potentially a bargain for shareholders? Now, when I say 10 times free cash flow, that's not exactly perfect, because that not 100% can go to you, because they are paying down a significant amount of debt. But before going into this question of whether or not, this is the deep value and it's worth, taking a swing, first of all, none of this is financial advice. I'm just sharing my personal thoughts, whether or not I'd consider Kraft Heinz for my personal investment journey. And also, quick plug, Pinkle, a premium Unrivaled subscriber, previously shared, I've been with you for a year and it was a game changer for me. Thanks for creating this service. We have an excellent community. This follows Colin on our exclusive Discord, who said, Unrivaled, literally, this is, quote, saved my portfolio, my pension, that is. So if you're looking for compelling ideas, come check out Unrivaled Investing. By the way, the premium tier will be going up in price in the next few weeks. So now is the time to lock it in for the premium tier. So going back to thinking about this business, once again, lots of free cash flow. Global Taste Elevation, this is clearly the more favored business that, management saying, hey, this is the favored child. North American grocery company, less so. $4 billion, $2 billion. When you're looking at this elevation company, I'm thinking of elevators over here. So they were talking about how they're the number one global sauces and meal player. This is really led by the Heinz brand. So the Kraft Heinz merger, Heinz was the favored child, doing very well. 90% penetration in U.S. households. And it's driven by Heinz, Philadelphia, Kraft mac and cheese. So these are some of the brands that you see here. That's driving this. Now, when you're looking at their, different segments, Heinz brand growing around 7% the past few years, looking at emerging markets growing around 10%, looking at the away from home market growing around 5%. These are supposed to be the good figures that they call out, by the way. Doesn't really get me that excited. I would rather see a consolidated sales figure. Once again, I'm probably quickly going into the camp that Buffett's in of, hey, I don't trust management. Why aren't they upfront with me with these sorts of things? Or, why don't they work with Buffett? And this type of growth does immediately suggest to me that really, even this brand, the favored of the splits in terms of the two different, entities, isn't going to be a high growth company. You're talking about single digit type of expansion, fundamental growth going forward. When you're looking at their North American staples company, this is going to be, once again, a lot of penetration in terms of U.S. households. 90% of U.S. households, have some of their brands, but it's a lot of things that frankly are dying or that just doesn't have the growth that it previously has. And this has been for several reasons. I mean, you can see the Lunchables, Capri Sun, Oscar Mayer Wieners, Maxwell House Coffee, Jell-O, Kool-Aid, Kraft Singles. Personally, I think the best thing that goes on a burger is Kraft American cheese, but everyone has their own preference. Some people say it's cheddar and Kraft American cheese is sacrilegious. Personally, I'm in the Kraft American cheese camp. I think a key part of the reason why this portfolio of companies has been losing value over time, and this is why this book by Joe Coulombe talking about Trader Joe's is actually very thought-provoking as it relates to Kraft Heinz, is he runs, if you're not familiar with Trader Joe's, a series of grocery. Or he used to run. He was the founder of Trader Joe's, which is a grocery chain. And the chain is very different from a lot of other grocery stores because you actually enjoy going there. At least personally, I do. You never know what sort of brands you're going to see there because it's predominantly private label brands that they have brought in-house. They're controlling the experience, controlling the brand experience where oh, this is going to be Trader Joe's. Oh, I'm going to like it. Very similar to Costco's Kirkland brand, which has been absolutely crushing it. One of the largest brands in the world. I think more sales than maybe even Nike. I mean, it's just incredible how big that has become. And so the ability to control the experience, get higher margins by owning your own private label brand has come at the cost of these other brands like Kraft Heinz. And so that's why you're having this struggle with companies or this subsidiary or this business segment split that's the North American, staples or grocery company. And so I look at this and I go, this is a bunch of brands that you're not going to see in a Trader Joe's. Trader Joe's keeps taking market share. This is something that's going to be fighting for space at a Walmart or a Target. And so it is an interesting dynamic. When I think about, what's going on though, despite this sort of putting a little bit of lipstick on the pig, you're still seeing a company that's clearly losing market share. Revenue in the most recent quarter down, even across, a split across these different segments. North America clearly facing the toughest competition, but the segments that are supposed to be doing real well, emerging markets only 4% growth. I suspect those markets are growing even faster. So I suspect they're losing market share across the board. That's what I suspect. North America alone is not good. And then when you look at their guidance for the year, it's not getting better. They're talking about around 2-3% organic sales decline, talking still about $2.60 in earnings, so around 10 times earnings. So that's the 10 times free cash flow that I was talking about. But overall, so you have this low valuation, but the picture isn't getting better on a consolidated basis. So what do I think, going forward? I go to Flash, my free AI assistant, so feel free to see the link below. And, it's calling out, look, the quality of this business, it's really not there. What once was is no longer. Where, the capital allocation really stinks. Management alignment, we'll talk about that further in a second. Track record clearly stinks. Financial health, not great. They have a sizable amount of debt, of which it would take them years to pay it off given their free cash flow. I think it's like $20 billion in debt versus $3 billion in free cash flow. So you're talking about years free cash flow would need to go 100% to pay off that debt. And then their market position, a lot of their products are number one or number two, but it's not like they're rapidly taking share. And so overall, thinking about the upside, downside, I'm in the same camp as what Flash is saying here, which is maybe 100% roughly upside and maybe 30% downside if things continue to get worse. Overall, I just don't find it to be compelling enough to get my, interest, because when I think about my own checklist. By the way, all of that I just showed you, once again, that was completely free to use on Flash. But when I think about Kraft Heinz, KHC, even the split up, aligned management, clearly not. Because aligned management shows, hey, if you actually cared what the minority shareholders said, this wouldn't happen. You wouldn't have Warren Buffett going, I'm disappointed. Here's a man, he just celebrated his birthday. Happy birthday, Warren Buffett, if you're watching. Just celebrated birthday on August 30th. He doesn't want to be dealing with this. He wants to be, focusing on counting all the cash flow that's coming in. He wants to think about, hey, what are all the opportunities I'm going to invest in when there's a global, financing crisis, as you're starting to see in various different, sovereigns with their debt interest rates spiking higher. He's thinking about, how can I invest this? I'm trying to figure out how to invest myself. Where am I going to deploy that capital? I call out my ideas to my subscribers at Unrivaled Investing. But I think aligned management, clearly not the case. The fact that this happened with Warren Buffett, I don't think they would, if they don't care what Warren Buffett has to say, they certainly won't care what I have to say, for sure. From a compelling valuation, I'd say it is kind of interesting, around 10 times free cash flow or under. Obvious growth potential, that's where it clearly fails. This is a business that's been contracting recently, clearly losing market share. And just from my own perspective, even though the valuation is compelling, my journey is that I want to focus on stuff that fits this whole checklist. And that's the reason why this checklist does remove the vast majority of companies. Wouldn't surprise me to see an activist get involved. Would not surprise me to see management get fired. Would not surprise me to see a complete, falling back and saying, this whole split up, we're not going to do that. We're going to bring in new management that hopefully will right-size the ship. Easier said than done. Too hard for me, though, as I think about it, because it doesn't pass the checklist. I want to find things. And I've called out in one of my most recent letters, one of my top positions, a company where I'm like, you don't find many where you're saying, I think this company has the potential to grow at a teens rate for the next 5 to 10 years at a minimum. And those are the types of situations where when you have the aligned management, they own 40% of the company, the valuation strikes you as compelling, and they have that growth. That's when you go, okay, how much of my portfolio am I thinking about putting into this versus these types of situations, which is at best, you're talking about maybe a special situation, saying, hey, an activist gets involved, maybe the share price bounces, and maybe they eventually turn things around. I don't see a clear path to that, but I welcome your thoughts below. Thanks so much for watching Unrivaled Investing.